This episode of the Commercial Real Estate Investor Podcast is brought to you by CRE Launch Pro. This online commercial real estate program is designed to take you from beginner to pro commercial real estate investor with access to all of my courses, our online community, and monthly group coaching calls. Learn how to confidently buy your first commercial property today at www.crelaunchpro.com. Welcome back to the Commercial Real Estate Investor Podcast. Today, we're going live with another Brokers Roundtable. If you ever want to jump in and ask us questions, feel free to do so. We do this on YouTube every couple of weeks. You can typically find the schedule on our Instagram accounts, whether that's mine, Chad's, Adam's, Jesse's. We tend to all share it so that everybody's aware of it. Chad, what's going on, man? It might just be you and me today.
It's more of a fireside chat as opposed to a roundtable. Eh?
That's right. That's right. The table's not so round today. Man, you're all dressed up. You've been out pitching clients today?
I was actually working, and I don't wear a suit often, but I'm trying to do a suit at least once a week. And Bob Knackle, who's a legend in the real estate space, he wears a suit and tie every day. And I think if a guy that's as wealthy and as successful as Bob is can wear a suit and tie every day, I can do at least one a week. So today happens to be the day.
I love it. Bob Knackle's awesome. We had the opportunity to interview him at an event in Atlanta a couple weeks ago. So really excited to get that video out. Well, today we're going to be diving into part 2 of commercial real estate investment sales. A couple of weeks ago, we kicked it off thinking very naively that we would be able to get through everything that you need to know about commercial real estate investment sales in a single episode. And we got through one of basically 4 parts that we had thrown together for this live stream in the entire hour that we had worked on this. So if you want to dive further into, prospecting for off-market opportunities or off-market potential listings as a commercial real estate broker, go listen to part 1 on the podcast. Today, we're going to kick it off with valuing deals. As a commercial real estate investment sales broker, you have to have the knowledge, the wherewithal to help a client properly value their deal. Sometimes they want numbers that don't necessarily make sense, and it's also on you as the broker to help guide them as to what that might be, right? I mean, I've had plenty of instances, and Chad, I'm sure you have too, where a client tells me, I want $1 million for the property. Well, Mr. Jones, it's actually worth probably 1.4. I think that's where we should list it. It's your responsibility as the broker to make sure you're getting the highest and best price for your clients because that is in their best interest. So, Chad, when you're looking at commercial real estate investment sales opportunities, let's assume you've already gone through and you've cold called an owner, and they say, you know what? Yeah, I would be interested in taking you up on your broker's opinion of value of my property, right? Because we're doing that for free. It's a foot in the door. How are you going to go about comping out that opportunity in the best way possible?
Yeah, and it's a great question. And even just before we jump into that, so interestingly, I started charging for BOVs a while back. And you've got to be careful depending on what jurisdiction you're in that you're not acting or holding yourself out as an appraisal. You've got to put very specific language in there, and there's got to be disclosure. And so I'd say if you are going to consider doing it, make sure that you're abiding by your local state rules. But I started charging them for them for a while for the reason that early in my career, I gave out a ton of BOVs for free, and that never materialized. And maybe you get the odd one, but I just thought that I didn't want to run the same model that a contractor does, where a construction company might give out 20 bids with hoping of winning a couple of them. I wanted to have a higher probability of successfully getting those after. So my sales pitch was pretty simple, and I still use it to this day, is that I charge anywhere from $1,500 to $2,500 for a BOV, and it's pretty simple. I say, I can give you a simple BOV for free. But if you want me to dive into this and really go and get all the comparables we're talking about and do a real analysis on this, that just takes time. It could take me 10 to 20 hours to do one of those. So for me to do that properly, I have to charge for my time. However, if we end up listing the property and we sell it down the road, I'll credit that back to you. So it does a couple things. One is it incentivizes the broker to actually put more time into it, knowing that it might not just go into the abyss. And quite often people could use those BOVs and try and sell it to someone else and use your report that you put time into to sell it to a tenant or sell it to their accountant or whatever it is. So if by having some money come in, it's not a large amount of money, but it does help offset costs, and it just motivates you to put more time into it so you fully understand it better. Then they're also more invested in you. They're actually giving you a $1,500 check or $2,000 check. So the chances of them saying, okay, well, you put together a really good report because you're getting paid for it, and you're going to credit me that back, and now you know the property as well as anybody. There's a lot of reason to be consider that as just another way, not just to make a little bit of money, which is always great. I mean, getting a $2,000 check versus not getting it is always better than the alternative. But you're spending more time on that property, and then you're getting them more invested in you. So I think that there's a lot of reasons to actually charge for one. But if it comes up that you can't, and the owner just says, I've got an investment property I want to sell, what's your opinion on your value? Well, maybe you do have to make a decision to do it for free. But I would challenge agents out there to consider actually charging for one for those reasons that I mentioned.
Yeah.
On an investment be oh, sorry to cut you off.
No. I was just gonna say, I really like that approach because it gets them bought into working with you, right? It's that like, you know, you get a client to spend $1 so that they'll spend 10, right? Just get them to spend that first dollar. And it makes a lot of sense, right? Because if you think about it, you get what you pay for. And as a property owner, if I'm paying somebody $2,000 for a broker's opinion of value, I'm expecting that to be a lot better than one that's free, right? Because the guy that's going to do one for free is probably going to go on to CoStar. He's probably just going to pull off a couple of, 3 to 5 sales comps that CoStar has, which we all know is not always accurate, and send it over with, hey, I think your property's worth X. Except, it might not actually be worth that. It's not, you didn't spend any time on it, and it may not actually matter. I mean, my approach has always been, we'll do a free broker's opinion of value, which I might talk to the team about, using your strategy there. I think that's pretty great. I need to meet you out on the property and walk through it with you and hear from you, like everything that's going on there. I need to see inside, outside. Let's walk through it. And, I'll get together a full report for you because it gives me that opportunity to build a relationship with the owner. And it sounds like that's kind of what you're doing too.
I think that's exactly it. Is if you are asked to do a BOV on a property and you do it for free with the hope that you're going to get business down the road, I think that undervalues, first of all, just what you bring to the table. You're charging nothing for that report with the hope that you get a listing on it. But if you don't end up getting that listing, if the owner decides that the price isn't right or he sells it to somebody else, you just did all that work for free. And I think that undermines our profession, where we do bring a lot to the table. If nothing else, getting a good sense of the property, like you said, walking through it with them and really getting to understand what you're dealing with, and then digging up all the comps, which most often isn't just on CoStar. You have to go a lot further than that. You have to get a lot more information. We're relying on a lot of contacts. We're relying on all the shoe leather that we wore out in our careers, just walking up and down streets and talking to people. There's a significant value to that. And it's almost, to me, an initial test. If a owner isn't willing to spend $2,000 on a report that is worth that every day, assuming that you do it correctly and actually spend the time on it, that's worth $2,000 every day. If the owner is not willing to do it, that's almost a bit of a flag to me at the beginning. So get them invested, get them understanding what you're giving them. And it can be very simple. Like I can give you a simple report. If you just want a 1 or 2 page letter, I can do that. And if you need that for whatever reason and you just don't want to pay, I can do that. But if you want a comprehensive report and it's going to take me 10 to 20 hours, there's a cost for my time. So that's where I always circle back. And I've done this on large properties too. This isn't just like a small property where someone's willing to do it. The first large property I ever sold, actually, this goes back 15 years now, was a $7.5 million building. And at that time, I was mostly working on smaller stuff. I did this with that owner, and that took some balls to do, because he could have just said, "Well, I'm not going to pay for an opinion of value. I'll just go and find another guy." But I broke it down. It's presenting why it makes sense to do it. And again, I broke it down. I can give you a quick number. If that's what you want, I can do that. But for me to go and put together a comprehensive report and show everything about this building and dig into all the comparables and get access to information that isn't publicly available, and then synthesize this and put this together into a report, it takes time. So I hope you could appreciate my time on that. And again, if we're successful in selling the building and you use me for it, I'll credit you that anyways. So like, to me, that's selling. That's what a job of a broker is when it comes to selling. Selling isn't using cheesy lines or trying to trick somebody into doing something or trying to be overly persuasive. I don't think that that's professional selling. I think what brokers do to sell is presenting an option, telling them why that's an option that makes sense for them, and then letting them give you an answer on it. And that's how you present that. Is, here's the value. Here's why there's a cost to that value. Here's what this is going to do for you. And then this is how we'll work together in partnership going forward. That's selling. And I think that that's really what a job of a broker is. I realize we're probably running off on the second episode of this. We're already running off topic, just like we did on the first one. But I think that that's like something that a new broker or experienced broker can do to just really change the way that we look at doing free work. Because in my mind, a good broker brings so much to the table that we don't necessarily need to look at everything we do as free. There's value for what we do.
Yeah, I agree. I mean, I think that there's too much of an expectation in the world of real estate that brokers should be doing free stuff. And we get plenty of that anyway with working on deals until they actually close, and getting paid when the landlord gets paid or the seller gets paid. It's not an easy business, that's for sure. AM is jumping in the live chat. Always a pleasure listening to both of you guys. Would you be opposed to receiving off-market property deals? I mean, Chad, I don't want to speak for you, but I think everybody's always interested in seeing some off-market opportunities if they're good deals. I mean, if it's an off-market opportunity and the seller wants twice market rate, then I'm probably not going to be interested. But if it's a good deal, yeah, shoot them our way. I think we'd be interested in taking a look at them.
Yeah,
So
I'm with you. I'd look at any off-market deal, and I think that speaks actually quite neatly to this topic that we're having. Is that there's ways you can evaluate a deal really quickly, that back of the napkin or back of the envelope math, and get a sense for it. So I'd love to look at anything, and I'll either give a quick no or yes, I'm interested, and let's talk further.
yeah, I love those. So let's talk more about your broker's opinion of value, because I do think that, look, if we got to turn this into a 3-part, 4-part series, that's fine. It's a very in-depth topic, but I think the broker's opinion of value is very important, because it's one thing that can really set you apart as a commercial real estate broker if you have a professional report that's pulled together that makes sense. So Chad, what does your BOV look like?
This is a really interesting part about commercial real estate, is that it's a full spectrum of sophistication. You might have a brand new commercial real estate buyer who perhaps has owned a few houses, and they ran a very, very simple model of cash flow in, cash flow out, and that's just how they continue to evaluate deals, all the way up to very sophisticated institutional money, which runs super sophisticated investment analysis. And I don't know the best way still, after nearly 20 years of being in this business, I still don't know the best way of trying to come up with a package that speaks to everybody. The easy answer is that if you're evaluating a $50 million institutional investment, perhaps like a large distribution center leased to FedEx, that's speaking specifically to that institutional investor. And for the most part, they're running their own models anyways. They look at what brokers put together as probably, they probably say, that's cute. We'll take your numbers under advisement, but we're running everything anyways. Just give us the raw data. We're going to run it on our own. And on that other end, you're going to be dealing with a small investor who isn't going to understand internal rates of return and net present value and discounted cash flow analysis and sensitivity analysis. You're just speaking way over their head. So I think the best thing that I've found is that you really need to speak the language of who the buyer is going to be. So and you get a pretty good sense of it, right? If someone calls you and they have a small little strip center that they want to sell and it's $1 million, you're probably not going to put together the same level of detail as you would if it was a shopping mall for $100 million. So I think that that's the first step is really get a sense of what you're dealing with because that's the language that you're going to have to speak for the ultimate buyer. So it ranges. Like for me as an investor as well, and I would say this very confidently is that I got a much better understanding of investment properties when I bought my first investment property. I had a pretty good idea of it beforehand. I did my CCM designation when I was early into my career, and helped people buy investment properties. But it wasn't until I bought my first one, and then subsequently more over the course, where you actually learn a little bit more every time. And I'm sure this is the same with you, Tyler, is that you're a much better investor now, having gone through the process several times than when you were dipping your toe in the water and saying, what exactly am I doing here? So it's a fascinating area of the business, and I think that this is what people really enjoy about it, and why it's such a career that people can stick with it for so long, is that you're never dealing with the same property twice. Even if you did have the same property or a very similar one, the buyer is going to be completely different, and they're going to have completely different expectations on it as well. So perhaps how I could frame it first is I'll talk about it from my standpoint of as an investor, and then I'd love to hear your thoughts on it too. And then I think that that could help frame how I would now advise someone on an investment property. But my first thing, and this is just from owning a decent amount of property right now, and is I always look at my downside risk first. First and foremost, that's what I'm identifying, because I've found, and this probably didn't really resonate with me until I started doing it myself, is that pro formas can be manipulated to say virtually any number that you want it to. You make one little tweak to a cap rate, and that heavily distorts the value. You make some assumption that you're going to renew one of the leases in 3 years at a 20% escalation versus a 10%. Well, now you just skewed the numbers up. What your X cap rate is. Like all those numbers can be manipulated, and pro formas can look really good if you want them to, but what's your downside risk? And to me, that's what happens if that property went vacant. Maybe you have a single tenant building, or maybe it's five tenants in a building. Maybe all of them just decide to leave for one reason or another. What's that property worth vacant? And that really just comes down to what your basis is. So that's the first thing that I'm always going to look at is what's the cost per square foot? And if I know what the cost per square foot on what I need to buy it at, and I can ascertain what the lease rate is fairly quickly, which isn't difficult, I could find out the lease rate for an asset class relatively quickly in almost any market. So if I know that the cost basis is $100 a square foot and my lease rate is $10 a square foot, and no matter what the leases are currently at or whatever the pro forma gets manipulated to say, if I can know those numbers, then I can at least evaluate what my downside risk is. And I think that this is, again, this is just experience of mine, is I think that this is overlooked, where buyers will look at a property and they'll just look at the cash flow and they'll say, oh, this is a great property. There's a large tenant in there paying $15 a square foot for the next 5 years. And they just see that attractive return. And that's great. And if that did come to fruition, you just had a great investment. But what happens if that tenant leaves? They go bankrupt. You just didn't anticipate that they were in financial trouble, and they go bankrupt. And now that space is worth $10. Well, if you evaluated it based on $15 a square foot rent and the market rent is $10 a square foot, you just lost a third of your investment right off the bat. So before I do anything, like step one, and if it doesn't go past step one, I stop immediately. I don't even go through the exercise of designing a pro forma. What's my downside risk? Like that's just where it begins and potentially ends. If if that looks good, and that's why I can usually just give a pretty good number on a property, is I don't even care if there's 10 years left on the lease and there's tenants in there. If the numbers don't make sense with that building being empty, I'm not interested even if it does have tenants. Then once you start going through it, I've become rather, I don't want to say cynical, but definitely more laissez-faire when it comes to actually in-place cash flows, because everything changes. That's like, we went through a pandemic in 2020 where a number of tenants couldn't even pay their rent. There's so many scenarios that can come up. A tenant loses a contract and now they can't pay their rent. I like to look at it that you can build your pro forma based on a rent roll, and you can make a lot of assumptions. And I mean, who would have even expected interest rates to go up as fast as they did?
Right.
So I doubt many people had that in their 10-year pro forma going in 2021. I doubt many people anticipated that in their cash flow. So there's just so many assumptions to make that my foundation as an investor, and this probably sounds very simple, and if there's an analyst listening, they probably roll their eyes at me as being simplifying this so much. But if you